Hey Bowtie Nation, Joseph Hogue here with a simple question for everyone out there. Do you always want to depend on people like this to feed you stock ideas? You know we love those stock picking lists here on the channel, finding the big picture forces and then drilling down into the best stocks to buy. But my number one goal for Let's Talk Money has always been to show you how to invest, how to find your own stocks, and how to be a better investor. That's why one request in particular stood out when I asked in our Facebook group about which videos you want to see. A step-by-step to valuation metrics on Yahoo Finance. All you out there in the nation have seen me use Yahoo Finance in the videos. I use a lot of other research tools, but Yahoo is the one that's free and easily accessible to all investors. So for this video, I'm going to show you how to use Yahoo Finance to analyze any stock. I'll walk you through the entire process from research to valuation and comparisons against other stocks. Stick around because towards the end, I'll also reveal how to do it all in 5 minutes when you have to make a fast decision. Now folks, understand, when I am analyzing stocks, it's usually starting from a theme or a group of stocks. I scan the Wall Street Journal, Bloomberg, and Yahoo Finance each day for news, and what I'm looking for here is a bigger picture story. That's because it is so much easier to start with a big picture theme that is going to affect a small handful of stocks and then research those for the best to buy, than just to jump into a market of 7,000 stocks and start your research from there. So here what I'm doing, I'm looking for broader news stories, those big macroeconomic forces, and most of what you see here on Yahoo Finance is going to be spammy trash and ads. So I also scan the old school sources like Bloomberg and Wall Street Journal. So I'm going to look through here, something about Victoria's Secret and push-up bras, so I'm going to save that for later, but not really big picture there. We'll keep scanning here. A lot of election crap, but here's one on Jeep owner Stellantis warns of deterioration along with the global car industry. So let's check that out. Reading through here, I can see that car makers are facing a down cycle, lower prices, higher competition, and botched EV transitions. And so then if we take that and look through some of the car stocks, we can start to get a sense of this. Starting with Stellantis, ticker STLA, over the last 5 years, we do see considerable weakness here since March, with the shares plunging 51%, losing half of their value just in the last 6 months. Looking at Ford, it never really did rebound from the 2021 sell-off, but you do see some weakness here since March, down 20% over the period. Shares of GM haven't fallen, but have basically flatlined over that period, over a strong rebound late last year, and Toyota, ticker TM, is down 30% since March. So while there is a difference across the group, we're definitely seeing that bigger picture weakness over the last half year, and you need to know which companies are stronger, which might already be in value territory, and which could be good buy candidates as the industry finds that bottom. So I built out a spreadsheet using Yahoo Finance data, and I'm going to toggle back and forth with Yahoo Finance and the spreadsheet, show you how to find each one of these and why it's important. Now you really do, most importantly, you really do need to be focusing on within an industry. So stocks within an industry. Here we're looking at the car makers. So we're going to be looking at 4 stocks, 4 of the major car makers here: Stellantis, Ford Motor, General Motors, and Toyota. Now, a lot of you are going to say, well, what about Tesla? Why didn't Tesla make the list? I don't know if Tesla is really a car maker anymore. I consider Tesla more of a tech company. It's got obviously a lot of that tech growth. It's moving into the robotics and self-driving cars, so not quite comparable with these. And that's really the important issue here, is comparability. You want to compare these fundamental, these basic measures like revenue growth, like payout ratio, like operating margin or profitability. You want to compare those against comparable companies, right? If we included even Tesla in here, if we included other industries like chip makers, if we had Nvidia in here, its revenue growth of 125% this year would make even the best revenue growth in this list look, nothing, pitiful. So what we want to do, we want to compare these against just car makers, just stocks in their industry. That's what you want to do when you're comparing stocks across stocks to buy. You don't want to compare apples to oranges here, so to speak. You want to compare apples to apples. You want to compare the same stocks in each industry to see which really has the best revenue growth, which has the best, the best operating profitability, and other fundamentals like that we're going to watch. So you'll see here that I did start, I got the prices down here, and of course, obviously, those are pretty easy to find here in Yahoo Finance. Also did the dividend yield as well as the payout ratio. Now, the dividend yield, you can take it directly from there, or you can calculate it yourself. A lot of these things that you're going to get from Yahoo Finance, you're going to want to double check them, okay? Because there might be some currency conversion issues, especially with Stellantis here and Toyota. You might have currency issues here that didn't convert very well in the numbers. You might just have different numbers that you want to look at, or stuff that just doesn't match up. So we're going to look at some of these you want to see. So we do see that Stellantis has a 12% dividend yield. Now, I would not expect that to keep up. We do see that the share price has come down so much, has come down by more than half over the last 6 months. I do not expect that dividend yield to hold up. I'm not sure that Stellantis would be on the path to cutting its dividend. That's why we included that payout ratio that we're going to look at. But a 12% payout or dividend yield for a car maker is just not sustainable. Okay, they need to be reinvesting more money into their cars or into their production, into their research and development. They can't be paying out a 12% dividend yield. So what we're going to do here to double check this is we're going to look at the dividend, and here in Yahoo Finance, when you look at the dividend, understand it says forward dividend. So that's assuming that the most recent dividend continues forward for the whole year. That's how they get that. And if you want to find that, you find the historical data tab. You go here to, I like using 5-year data. You go to dividends only and apply. And if you look at $1.65 was the most recent dividend. And what they're saying is they take $1.65, but it's only a 1-year dividend. So Stellantis, a lot of foreign car maker or a lot of foreign stocks, especially European stocks, they only pay dividends once a year. So they're saying that $1.65 is the same dividend they pay every year from here on out. Just kind of an idea. Of course, obviously you can see that the dividend has grown over the last few years, so you can kind of look at dividend growth with those measures there. But we're going to take this $1.65, $1.66 that they've said forward dividend, divide it by the stock price. So $1.65, we got it right there, divided by 13.70. That is our 12% dividend yield. Okay, and again, I would not expect that to continue for them, but we'll see how that goes. Payout ratio, very important for dividend sustainability. You know, is this company going to be able to continue paying out that size of a dividend? The payout ratio is the dividend amount. Okay, the dividend amount per year divided by the earnings per share for whatever year or whatever period you're looking at. So obviously very important. A company can't be paying out 60, 70, 80% of its earnings every year as dividends and be expected to also grow, also be reinvesting in that company, because the money that they're holding back out of those earnings, not paying in dividends, is the money they're investing in that growth, in that research and development, in those processes and other things. So generally, you want to see a lower payout ratio. Again, this has to be compared within industry, because you know, some of these payout ratios we're going to see 44, 31, just a 5% payout ratio for GM might be risky. It might not. You have to compare it against other companies in the industry. If you look at other companies, other industries like REITs, real estate investment trusts, you're going to see payout ratios in the 80s and 90%. If you see other industries like utilities, like consumer staples, they're going to have very high payout ratios into the 70, 60, 70%. And that's just because the cash flows in those industries, in utilities, in consumer staples are very stable. They know exactly how much cash flow they're going to have every year, years into advance. So they can pay out more of that as dividends. It's older, more mature industries, so they're not reinvesting quite as much into those business. They can pay out a higher payout ratio and be just fine. If a car company was paying out a 60, 70, 80% payout ratio, they would be in danger because they wouldn't be holding enough earnings back to be reinvesting in the company. So that's why we see much lower payout ratios here for these. Stellantis, a 44% payout ratio. How I got that, and for a lot of these, I used a little bit different calculation than what you're going to see in a lot of these with Yahoo Finance, because since we do see a lot of the earnings, some very big earnings changes this year for these companies. So we see, for example, we're going to see earnings for last year for Stellantis were $6.40 a share. This year expected just $3.73. So big drop in earnings this year. That means that taking that payout, the payout ratio or the dividends paid, so that $1.65 divided by the last year's earnings, which is what most payout ratios are going to do. If you see payout ratios in Yahoo Finance, in most companies, or most websites, in fact, we'll look at this. We're on the statistics tab. You're going to find your payout ratio here. Let's see where we can find that. Here we go. Dividends and splits. Payout ratio 35%. Okay, so what they're doing, they're probably doing a little bit of a combination of the two, because we would have, if we had $30.65 and that 35%. So $1.65 divided by 0.35, they're assuming of $4.71 in earnings. So maybe a blended average of the last year and this year. A lot of websites are just going to take the payout or the dividend amount divided by the most recent earnings. So the most recent year earnings, the trailing earnings, which of course here would be $1.65 divided by $6.40. You get a 25% payout ratio, which would look great. It would look like Stellantis is only paying out 25% of its earnings for dividends. It's keeping back 75% to reinvest in the company. That would be great for dividend sustainability, for company growth. But what we see, obviously, is something very different. This year, they're expected to report earnings of just $3.73, which, obviously is something you want to investigate, research further. Why are they seeing this huge drop in earnings? Is it going to go into future years? What's the problem there? You want to investigate that further. But if we do take this $1.65 in dividends divided by 3.73, we get a much higher. We get the 44% payout ratio, and quite a bit less sustainable than what we would have with a 25% payout ratio. So you always want to kind of question how to do these calculations, whether you should do it on the trailing or on this year or even next year earnings. But what you want to do though, you want to do it similar. You want to do it the same for all companies so you can compare them. Okay, so you want to do it. You want to do it one particular way for all the companies so you can compare them and know that they're being compared fairly and justly across all companies. So that's what I did. I did the payout ratio as the dividends paid out over the last, the forward payout ratio or the forward dividends. So the most recent dividend times 4, or for the yearly payers, just the 1, divided by this year's earnings expectations. And I'm going to show you how to find those next. And what we do see is 44% payout ratio for Stellantis. Again, we don't know if that's super high or low or sustainable until we compare it to these others. We're going to do that here in a little bit when I show you how to compare these. For these earnings per share and the revenue growth, we're going to go here to Yahoo Finance, and we'll go to the analysis tab. It's really one of my favorite tabs here on Yahoo Finance, because you really get a sense of which companies are growing, which companies are turning those sales into earnings, and what they're doing with that. So what we can do here, we can go to earnings estimates. We see here the number of analysts covering those. So 16 analysts covering earnings for Stellantis, 18 covering revenue estimates. And for each of these, you've got the current year, you've got the current quarter and next quarter. But I really just look at the current year and the next year. Okay, I'm not as a longer term investor, I'm not really too interested in what they're doing this quarter, next quarter. I want to see what they're doing this year and next year. And we can see that year ago EPS, year ago earnings per share or profits was $6.40 a share. Okay, average estimate for this year, current year, is $3.73. So again, you see that huge drop in the earnings per share this year. And I've noted that here in the last year and this year. And then next year, they're expected to rebound somewhat. I'm going to close this out so it makes it easier. Next year, they are expected to rebound to $4.02. So we want to get a sense of, why earnings dropped so much, why they're going to rebound, and, if we think that those earnings can continue to rebound, hopefully back up to that $6.40. If those rebound earnings did eventually get back up to $6.40 within the next couple of years from that big drop, I mean, shares would be a steal right here. So that's what we're looking at in this stock. We're also looking at revenue here. We can see the average estimate for the current year, $183 billion, $189 billion for next year. That would represent a loss of 10% on their sales over from this year to next. Okay, so again, something that you want to research further. Why are they seeing lower sales? Why are they seeing crushing earnings on that? And then why are they expected to return to 3.7% growth next year? Okay, is that normal growth? Is that growth that's going to continue over the next several years? So I've added that. Now that's the last year's, this year's, and next year's earnings. I've also added the revenue growth here. This year, negative 10%. Next year, 3.7%. And I also wanted to get a sense of longer term growth for each of these. Okay, so I did a 3-year CAGR, which is compound annual growth rate. For that, you're going to go to the financials here. This is on Yahoo Finance. You're going to get the last 4 years of financials, or 5 years, plus the trailing 12 months. Okay, that TTM, that's always trailing 12 months. So you can look here, revenue Now, something weird with Stellantis is they did have a big merger, a big acquisition here that pretty much tripled their revenue. So when they did that acquisition, it kind of threw this comparability out the window here. So what I did for Stellantis, instead of the 3 years that I'm going to do for these other companies, I did 2 years. Okay, so what I did here, so you can take the revenue last year, 189 million, well, but it's in thousands, so 189.5 billion divided by 149.4 billion over the 2 years prior. So if we do that, 189,544 divided by 149,419, and then to get the compound annual, an annualized figure, because remember, obviously this is 2 years, 1, 2, then you're going to do this x to the y, your exponent, and for 2 years, you do 0.5. Okay, and so we see that 12.6 growth. Now, for one of these other stocks where we didn't have that 3-year acquisition that messed up, so we'll see Ford here. Let's do Ford real quick so I can show you how to do a 3-year, because it's generally the one that what I like to do is 3-year or 5-year. Really gives you a better sense of longer term growth, what maybe trend line growth is for these companies. So we'll go here to Ford. We got the financials here, and we can see that it was quite a bit more stable here. Stable growth, 176 billion last year, 2023. 3 years ago, 127.1 billion in 2020. So if we want to get a 3-year compound annual growth rate on the revenue, we go 176, 191 divided by 127, 144. Okay, so that's 1.3857, right? So 38.5% over the 3 years. Now to find the annualized. So that's 3 years. We want to find an annualized x to the y. That's the exponent. And since it's 3 years, 1 divided by 3 is 0.33. So 0.33 there, 11.36. Okay, that is your compound annual growth rate, your CAGR, 3 years for the revenue growth for Ford there, 11.3. And you'll see I've noted that down, 11.4 here. Okay, so that's how we're finding this. Again, very important to find not just the near-term growth in revenue, but a little bit longer term to see, what are they doing now? What are they doing expected to do next year? Why is it so much lower than these longer-term growth rates? Why was growth so much better out of the pandemic? Obviously, we had a lot of stimulus money going into cars, lower car prices. A lot of people took advantage, and car companies saw some great, huge growth over the last 3-year period. That is obviously slowing down, and we want to research that. We want to investigate that to see, okay, where are car prices now? What is the inventory of car dealerships and car makers? Is it too high? Are we likely to see more weakness in years, or can we start seeing this trend line growth back up to 4 or 5% a year? That's really what we want to see. Another very important metric here we're going to look at is operating margin. All you out there in the nation know this is probably one of my favorite metrics right here is operating margin. That's operating profitability. I'm going to show you how to find that, but that is the core profitability measure for a company. Okay, we're going to go to Stellantis here, and a lot of times you can just find this right off of. We'll go back to Stellantis. You can take this right off of Yahoo. Okay, again, you're going to want to double check these numbers, but it is something that is generally correct. Okay, so profitability, we're here on the statistics tab. For Stellantis, we see profitability operating margin is 9.3%. Okay, so we're going to update there. 9.3% is our current operating margin. Now to double check that and to get that 3 years ago, so this operating margin 3 years ago, to get the trend, I really wanted to see the trend. Is that car company becoming more efficient, more profitable, or are they losing profitability? What we'll see with some of these here. So to get that trend of the 3 years ago and to double check this 9.3% number, you go here to financials. And here for the profitability, what you're going to want to do, you come down here to operating income. Okay, operating income. So understand total revenue. Then you got cost of revenue. Cost of revenue is things like paying suppliers, all those materials, things like some factory costs, things like that. That's your cost of revenue. What you're going to get there is gross profit. You'll hear a lot of times gross profitability, gross margin. Their gross margin is the gross profit. So what's left over after taking out all these costs of revenue, what's left over of sales. Then you've got your operating expenses, and this is all those selling, general, and administrative. So your marketing expenses, your staffing, your employees, your advertising, a lot of that stuff, the research and development they're spending, so reinvesting in that company, things like that. A lot of these, just those core costs to run this business. And then after that, you've got the operating income. So your sales, your revenue, minus your cost of revenue, those materials, factory costs, a lot of that stuff, equals your gross profit. Now that gross profit minus all your operating expenses, the core costs to run that business. After that, you're going to have your operating income. Okay, so gross profit minus operating expenses equals your operating income. And again, this is where I like to find that core profitability measure for the company, because, a lot of people are going to use the net margin, right? Or the net profitability. They're going to use the earnings divided by total revenue to find, how much in earnings they produced or what earnings profitability was from that. But, this operating income, that captures really the core profitability. Okay. I don't care about their interest income, their income expenses, pre-tax taxes, all that kind of thing. That's really not the core operating profitability of the company. Okay. So I want to use this operating income instead. What you're going to want to do to find the operating profitability, or just to double check that number that you got before, you take the operating income, which is 22,984 here, 22,984 divided by the revenue, okay? Because the operating profitability, operating margin is what is left over for operating income after all these costs. What is left over from that total revenue? So that divided by the total revenue here of 189,544. Now that says 12%. Okay, so obviously there is a difference there that, and Yahoo's calculating their operating margin slightly differently. Okay, so if you are going to use, for example, this 3-year one, which we will in this back here, then you're going to want to use the same calculations. So here I would want to update this to what the calculations say on the financial statement. Okay, so that's 12.12%. So 0.1212. Okay, so 12% for the current operating margin. Now we could look into why it says something differently on the statistics tab. My guess is it's probably a difference between GAAP and non-GAAP. Okay, non-GAAP reporting. So basically, when a company reports its financial statements, it is reporting. It's reporting GAAP. So generally accepted accounting principles. These are the accounting standards that tell a company how to report its earnings, how to report its financial statements, things like that. And there's rules it has to follow in reporting those. Now, they're not always necessarily a real world scenario for what the earnings, what the operating income, what a lot of these numbers are. So we also have non-GAAP. Okay, non-GAAP is a way of reporting those financials that maybe reflect a little bit better the reality of how that company is operated and how it is performing. So what my guess is here is probably these numbers here are GAAP reported. So this is what the company actually reported in its financial statements, and then statistics here is maybe the non-GAAP numbers. So I don't know. It's one way or the other. Again, though, you just want to make sure that you're using the same calculations across your companies so that you can really compare them across each other. Okay, because that's really what you're trying to do here is compare these companies the same way across different metrics for each other and see which one is the best to buy or to avoid, right? So we do see current 12.1% operating margin there for the 3-year. This is the one where you're going to go back and you're going to try to find the trend there. And for this, what I did is you go back to the financials here. You're in your income statement, and 3 years ago, so 2023 back to 2020, you're going to do the same thing. You're going to take your operating income here. So this is 3252 divided by their sales, their revenue, 47,656. Okay, that's different from what I had. I guess I probably took the 2021 here because I didn't want to get into the acquisition problems there. So let's try this. 15,859 divided by 149,419. So that was 10.6. So that's the one I used for the graph. What I was thinking is, here during the pandemic or during this acquisition that they had, obviously it's going to be very much their profitability, their efficiency, how the company is run might be very different. So I wanted to get a little bit more of a trend, a baseline, and a reality of what their operating efficiency is. So that's why I did for Stellantis, I did 2021 rather than some of these other for 2020. So I've got the 10.6% operating margin 2 years ago for Stellantis, 3 years ago for these other companies. And what you want to do here again is the company getting more efficient or is it getting less efficient in turning those sales into operating income? Here with Stellantis, we see it's getting more efficient. It's converting 12% of its sales into operating income, whereas 2 years ago, it was only converting 10%. And we're going to compare that against what the other companies are doing. Now for the price to earnings and price to sales, two valuation metrics, right? So basically this is, the price, if you think about what it actually says, the price to earnings or price to sales. So the stock price to its earnings, to its income, or the stock price to its sales. This is what investors are paying, are paying for every dollar in earnings or for every dollar in sales. Okay. If we look here, we got 3.7 PE for Stellantis. And again, I took this with the current years. What you're going to see with PE for most websites is a trailing PE. Okay. So if we go here to the summary on Stellantis, we can see they report the PE ratio of 2.82. Okay. Remember, we had earnings of if we go here to analysis, trailing earnings were about $6.40. The trailing 4 quarters might be a little bit different. I think it was like $4.70, but the prior earnings were $6.40, $4.70, whatever they used there. Now what they did, they took this $13.70. So that's the price divided by earnings. So 640, it probably wasn't that. It was probably that 470 that we found earlier. So 1370 divided by 470, that's right around that 2.8 times price to earnings. So the price of the stock divided by the earnings per share gives you this price to earnings ratio. Now, again, because the earnings for these companies have changed so much, especially Stellantis, for this year, I want to get a little bit truer price to earnings ratio, a true valuation for the current year. So I'm using the 3.73. So what I did here is 13.7 divided by 3.73. That is 3.6 times price to earnings. So what does that tell us? Investors are paying $3.67 for every dollar in earnings generated by the company. Okay, what does that mean? Well, we don't know what it means until we compare it with either the history of Stellantis valuation or these other companies. Okay, we don't know if that's high, we don't know if that's low, but when we do look at, okay, so over the last 5 years, Stellantis has traded for $4.40 per every dollar of earnings. Okay, it's traded at a higher valuation. It's traded more expensively. Investors have been willing to pay $4.40 for every dollar in earnings generated. Now, for some reason, they're only willing to pay $3.70. Okay, and obviously, I think this is as a result of some of the weakness that they've had recently. The warning we saw in that Wall Street Journal article, the warning of industry problems, industry high inventory and lower prices, things like that. So investors have gotten more skittish, especially on Stellantis here. They're only willing to pay $3.70, 3.7 times every dollar in earnings for Stellantis. So what we can say here, comparing the 5-year, and I'm going to show you how to find that, but comparing that against the 5-year, Stellantis is cheap against its own history. Then we'll compare it against these others, okay? And against these others, we obviously that Stellantis is very cheap compared to the others, but we want to wait till we compare that with those. So what I did for the 5-year average, and again, you really want to get not just the comparison with the other stocks in the industry, but comparison with the stock's own history as well. So 5-year history here, we can go here. Obviously, since Yahoo Finance isn't going to show us that unless we pay for the premium, what we can do here, we go to Morningstar, we go to the Stellantis page on Morningstar, and we go to valuations. Great resource here. It's going to give you 10 years of valuation data, right? So we can go here, price to earnings, the 4.4 times price to earnings over the 5 years. So this 5-year average. So if we took these 5 years here, if we took these 5 years, divided, I think they probably excluded this 2020 because that was obviously an outlier. But if we took 5 years of price to earnings ratios for Stellantis divided by 5, we get a 4.4 average. We also did that with the price to sales that we'll look at next, so 0.24. So we got the data for each of those from the Morningstar website in the valuations tab. And again, we can compare that, the history or the average of where the company stock trades with its current valuation. Same here, price to sales. Price to sales, I like to use price to sales more than price to earnings. A lot of you, all you out there in the nation, probably hear me talk about price to sales more often just because, okay, folks, when I was an analyst for enough years, I know all the tricks, all the shenanigans management plays to boost those earnings. Okay, if you look here, it really doesn't show you very well all the tricks they can use. But if you look here in the income statement, you've got a lot of tricks from revenue all the way down to earnings per share that companies can use to make those earnings look higher than they actually are, okay? A lot of ways to maybe defer operating expenses, maybe not pay operating expenses now or not account for them now, account for them later on. A lot of, all you old timers remember the thing about AOL and the CDs, all those discs it sent out decades ago, 20, 30 years ago, that really skewed this number, and they had to restate that. There's also selling in general and administrative tricks, manipulations, shenanigans, basically, that companies can do. So basically, this earnings per share, while that's something you want to follow, so something you want to understand, it doesn't always reflect reality of what a company is generating in income. Okay. Now, revenue, there are ways to manipulate revenue, make it look a little bit higher than it actually is, but there's much fewer shenanigans go on in this revenue. So that's why I do like to use the revenue valuations, revenue growth, things like that more than earnings or earnings growth. Okay, I like to look at revenue valuations, revenue growth. Okay, so what we did here with price to sales on Yahoo Finance, you can go here to the analysis tab, and again, when you look at the statistics, you're going to see price to sales here. You're going to see price to sales, and that's based on trailing 12 months, okay? That TTM. That is the price, so the price of all the company, so the market cap, $40 billion. That is the share price times all the shares available in the market. Is $40 billion. That is the market cap. That is the company's value. That is, something you can use for valuation when you don't have per share measures or per share data. Okay. So we take the market cap, 40 billion, divided by the revenue over the last 12 months. So the trailing revenue, and they get 0.21. Okay. What I did is I wanted to see how that is in the current year, because if this revenue has changed quite a bit, I want to get more of a realistic valuation. Really didn't change things much, what I found. So that's 183 billion. I go up to the statistics, go here, $40 billion revenue, $40 billion revenue divided by 183, it's 0.218, so 0.22. Okay, so it really didn't change much because, revenue isn't expected to change much. So only expected to change 10% this year. So current price to sales, market value, market cap divided by sales or revenue is 0.22. Okay, again, just like PE, that's price. What are investors willing to pay for every dollar in sales generated? Okay, and then we got that 5-year average from Morningstar. Again, comparing those, see if it's relatively cheap now compared to its history or more expensive compared to its history. Debt to equity, last one we'll look at it, and then we're going to compare these, show you how to compare these, and then that 5-minute recap, how to do this all in 5 minutes, what you need to see. So we can come down here and you'll find the debt to equity, 39%. Now, again, sometimes you gotta double check these because they just seem ridiculously low, ridiculously high, what Yahoo Finance is doing. Because if we see 39% debt to equity for Stellantis, a car company, you look at all these other ones that we'll see, 350%, 179%, 105%. So these companies carrying much more debt than their equity. Obviously, 39% would be great if it was realistic. My intuition says that it's probably not realistic. It's something that Yahoo Finance is measuring differently. So we really have to check that out and see what they are doing. So to find the debt to equity, really easy here. You just go back up to the financial statements. Your debt and your equity, it's going to be in your balance sheet. So if you look at your balance sheet, you find here your debt. And now generally this debt to equity, it's long-term debt. So it's, something like this $46 billion. These are in thousands. So $46 billion in non-current liabilities. That's long-term debt divided by the equity. Now, what they did, they probably didn't take all of these. Okay, so if they're doing 39% debt to equity, and your equity, that's here, this total equity gross minority interest. Okay, so total equity is 82 million. If they did 0.39, 39% times equity, 32 billion. They're saying $32 billion in debt. So they probably used this long-term debt and capital improvements. That's definite. That is definite something that you want to put in your debt to equity ratios. They also used maybe some of these others here, these trades, employee benefits, to make it easier. I would just use this entire non-current liabilities column or row, just to make it easier, plus to make it comparable to these other stocks. Remember, that's what you're looking at here, is comparability with these others. And obviously, that's not comparable if it's not measured the same way. So what we're going to do, we're going to update this a little bit. We're going to go here. We've got the non-current liabilities, 46 billion. So we want to take that 46 divided by 82. So the debt, long-term debt, not your current liabilities. Those are the liabilities. That's the debt and other obligations that have to be paid this year. We're looking at everything that's left over after this year. 46 billion divided by 82, which is our equity. That is 0.56. So a little bit higher, but not still something may be going on here. 0.56. And what I'm thinking here also is, Stellantis has so much current liabilities, so much debt coming due this year. Okay, if we look here, payables, pension, current debt, so they've got, payables and accrued expenses, 45 billion, current provisions, 13 billion. They've got a lot of debt that is coming due this year that they have to refinance. Basically, they're not going to pay all this current liabilities, this debt due this year. They're not going to pay all of that with just cash flow or their income or their earnings. Okay, they're going to take out more debt to cover this. So this non-current liabilities, this long-term debt, probably going to go up quite a bit for Stellantis after it reports over the next couple of quarters. That's going to go up. That's going to make this debt to equity ratio go up quite a bit as well. But the fact is, the bigger picture is it does have quite a bit lower debt to equity than a lot of these other companies. So less highly leveraged Stellantis than these other companies, and that is a plus for the stock. I'll get back to that process, but to stay on top of the big picture trends, I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign up link below. Now, once you have all this basic fundamental data out, and honestly, folks, it took a lot longer to explain that than it actually takes. You can set up your chart here, set up, you don't have to have all of these. I would recommend having most of these at least to give you a good picture. And you can always, you just save this chart and you update it year after year with with new data, and it takes a lot less time. But to really find all of this information, it's only going to take you maybe 10 or 15 minutes off of Yahoo Finance there. From there, you start comparing. You start saying, okay, I know that the car making industry is at a trough on its cycle. Prices have come down, inventory is up. Dealers are having trouble clearing their lots. So a lot of these car makers have come down quite a bit. These stocks. Where is that bottom? Do I want to get in on that bottom? And which stocks would probably be the best buys in that scenario, in that instance? So I want to start comparing them. Again, if you're a dividend investor, if you're really looking to those dividends, you can compare those yields there. I would not expect Stellantis to keep up that dividend yield. 12% is great. I don't think they're going to have a problem covering their dividend this year or next. So you are still going to get that fairly good $1.65, that fairly good dividend yield off of that. So that's a plus for Stellantis. Ford Motor has a very strong dividend yield as well, 5.6% compared to these other two, just 1% and 2%. Not really dividend stocks in my book there. So 5.6%, that would probably be another plus for Ford as well. And then but you do have to look at the payout ratio. Is that dividend sustainable? Are they going to be able to keep that up? We do see here that General Motors, just a 5% payout ratio. They are paying out almost nothing in their dividends. That is definitely something that they can grow into the future. If they even grow it to 20%. I mean, that would be a 5x, or well, it's almost 5%. So almost a 4x multiple on their dividend. So you'd be actually looking at about a 4.5% yield on General Motors for their dividend if they got this up to just 20% payout ratio, which is still sustainable. Toyota right around 18%. These two, Ford and Stellantis, I would want to be watching those if they weren't able to increase their dividend or their earnings, grow their earnings over the next year or two. Then these payout ratios would be a danger, would be something to start worrying about. Right now, I don't think there's something to start worrying about. They are obviously a little bit higher and a little bit less sustainable than General Motors or Toyota there. Looking at the earnings per share, I mean, this is huge. This $6.40 last year for Stellantis down to $3.73 this year. That would definitely be something we would want to investigate, research further. Why is Stellantis seeing so much lower earnings, especially compared to some of the others? Because some of the others don't look too bad. General Motors is actually expected to increase its earnings from $7.68 to $10 a share. Toyota and Ford to see slight drops. $2 down to $1.92 for Ford, $25 down to $22 for Toyota. So, only about a 12% drop for Toyota, less than a 10% drop, maybe about 5-6% drop there for Ford. Big increase for General Motors, but then almost half for Stellantis. So why are they selling so many fewer Jeeps? Or more importantly, why are they converting that revenue into fewer earnings? Because what we'll see is revenue, it's expected to be down 10%, but that doesn't explain almost a halving of its earnings. So we'd want to look into that. They are expected to see those earnings rebound a little bit, but just a little bit into the next year. So we definitely want to look at their operating profitability and why it's so much more or so much less this year if they're maybe making a big research and development expense, something like that. The other stocks actually starting to see Ford come down even further. This is a big problem. Okay, 1 year revenue down isn't something too bad to worry about. 2 years is a trend. So Ford is just getting less and less earnings per share there. That's bad. General Motors slightly lower, but after the big bump this year, wouldn't be quite as concerned about it. Toyota expected to rebound its earnings there. Revenue growth. Again, I've really watched this revenue growth. This is probably more important to me than earnings because I want to see where a company is growing its revenue. And more importantly, when you're comparing it in the industry, who's taking industry sales, who is taking market share? Because especially for a market like car makers that is basically set. Okay. Car makers, we aren't seeing explosive growth in the market for cars right now anymore. Okay. Everybody that has a car, probably going to have a car. Some people have, some people ditch their car each year. Some people buy a new car each year. But that growth, that general market growth is pretty well, around the growth of the global economy or the local, national economy. So it's not going to be a whole lot. If we see one car maker getting so much more, okay, so 3.5% growth next year. Look at the longer term averages, 18% growth for Toyota. Why are they able to outperform these other companies so much more in this, in this sales growth? Okay. And does that mean that they're taking more market share away from other companies? Okay. Very important, that market share, because it's sticky. Okay. Once you buy a Corolla or a Camry, a Toyota, you're probably the next car you buy is probably going to be a Toyota. Okay. Once you buy a Jeep, your next car is probably going to be a Jeep, more likely than not. So if these companies can take that market share, get more of the industry sales, then that's something that's going to be durable. It's something that's a competitive advantage, and it's going to be, it's going to continue to increase the sales and eventually the earnings for those companies. So what we see here comparing these is a big drop in sales this year for Stellantis. We'd want to see why. Why are people buying fewer Jeeps than last year? Lower for Toyota as well, but Ford and Motor expected 4.2, 3.5%. Now next year, expected to be just the opposite. Stellantis and Toyota expected to come up a little bit. Maybe it's models. We'd want to look at what models are expected to come out this year and next for these companies, and why maybe this year it's less popular for Toyota and Stellantis, more popular models for Ford and General Motors. So we would want to look into that. The 3-year CAGR, though, this is, what I like to look at is a little bit longer trends. I'm a longer term investor. If you're a longer term investor, this is what you want to look at: the 3-year, maybe the 5-year trends in these, and those compound annual growth rates. All right. And what we see here is these 3 companies, 11.8, 11.4, 12.6% growth a year. Very similar, very, very much similar across those 3 as far as annual growth in revenue. But Toyota just blows them out of the water. 18% 3-year growth rate. If that extended to 5-year and even longer growth rates, if Toyota was always, beating these other companies on their revenue growth each year, that would be something to watch for, because again, that would indicate some kind of a competitive advantage, some kind of a market share gains for Toyota. That's what I want to look at here. Again, operating margin, one of my favorite metrics here, that core profitability of the company. And we really want to see, why is it so much different for Stellantis and Toyota versus Ford and GM? Why are Ford and GM so much less profitable? And I gotta say, what I think a lot of this comes down to is the unionization of those. Stellantis, Toyota has a lot of their manufacturing in the South, fewer union shops in their manufacturing, so they don't pay the wages that Ford and GM have to pay. Ford and GM both striking a deal with the UAW, the United Auto Workers, just over this last year that had huge concessions to the auto workers, higher wages, and that if you're an auto worker, that's great. You're getting paid a hell of a lot more. You're getting a lot more benefits in those unionized shops. For an investor, for the company and its shares, not so great, okay? Because you are paying quite a bit more in wages and benefits. So I think that explains a lot of the difference in the operating margin here, okay? Longer term, we see the same thing here. The 3 years ago, 10.6 is still high, as a little bit lower for Stellantis. Somehow they're getting more efficient, so that's good. Also at Toyota, somehow they're getting more efficient. 8.1% 3 years ago operating margin, now 11%. General Motors is doing well, is doing better, 5.4% up to 8.1%. With this new union contract over this last year, I would expect that to decrease. I would expect that to come under pressure over the next year. So that would be something to watch. Ford getting better as well, negative 3.5%. So a negative operating margin, negative earnings, negative operating income 3 years ago, and now 4%. So all 4 companies are getting more efficient over the last 3 years. But we still see this big difference between the foreign automakers, Stellantis, Toyota, compared to the almost exclusively the domestic ones. Obviously Stellantis that does own Jeep, which is the domestic car, but it's a lot of it is also those foreign makers, and it also has a lot of the non-unionized shops there. So just something to think about, something to look at when you're comparing these stocks. PE ratios, again, you want to compare it against its own history. So against this, if we look at the 5-year average, Stellantis is cheap, Ford Motor is cheap, General Motors is cheap, Toyota is cheap. All of the car makers are cheap right now compared to their own 5-year average. And that's obviously because a lot of these stocks have come down with those industry troubles. The industry has really fallen over the last 6 months. We've seen that in those price charts, and these stocks have been getting cheaper, okay? Compared to each other, Stellantis by far the cheapest of the stocks right now. Now, again, I'm going to show you this in our 5-minute walkthrough, in the 5 minutes quick analysis here. That might not mean quite as much as you think it does. Okay, I'm a cheapskate to my core, cheapskate to the bone. But I would generally defer to higher revenue growth and higher operating margin, higher profitability in a stock. Okay, so if one stock has a much higher revenue growth than another, even if it's more expensive, then I would probably go with the higher growth rather than being a cheapskate and buying a cheap stock. Okay, a lot of times these cheap stocks, they are cheap for a reason. Okay, so you got to kind of take all of this as one. You can get shares of Stellantis extremely cheap here, 3.7 times on a PE ratio, 0.22 on a price to sales, but you've also got problems. You've also got negative 10% revenue growth. You've also got earnings that almost halved over the last year. You've also got some real problems in these companies. So you really want to take it as a whole and figure out, really which metrics you want to overweight and which ones you want to you want to underweight a little bit. Okay, if we can look at the price to sales here again. All of these are cheaper than their price to sales. Actually, Toyota is right at its long-term price to sales, so not quite as cheap. Toyota, I guess, maybe investors haven't sold off quite as much on that stock. Debt to equity, again, we can look at that. Which companies are over leveraged, maybe even dangerously so over leveraged. Obviously 350% debt to equity on Ford Motor. That is really going to limit their flexibility, their financial flexibility, how much more debt they can take on, and it's going to hurt the shares here. So what you're doing here, you're trying to get a whole picture of growth, of profitability and valuation for these companies. Now, if we go through here and we just kind of highlight the best things to look at for these, obviously, for 3-year growth in revenue, I would highlight Toyota doing very well in that longer term trend. Next year growth, Toyota and Stellantis doing pretty well, so maybe highlight those. Operating margin, I want an operating margin, the higher ones here, so Stellantis and Toyota definitely stand out there as higher operating margin, higher profitability, and that's something that is durable. I don't think that's going to change for Ford or General Motors. They are not going to be, especially over the next few years, as that union contract that they just signed, as that goes through and as those wages increase over the next few years is how they planned that out. It is going to make that operating profitability very difficult for Ford and General Motors, which still have, most of their manufacturing in unionized shops. So I'm going to highlight that, the operating margin for Stellantis and Toyota. For the PE, price to earnings, price to sales, obviously, Toyota is the most expensive, and it's probably for a reason. They've got very good, earnings or revenue growth. They are growing faster than any other company as far as revenue, as far as sales. They've got one of the higher operating margins, and it's a durable operating margin. So investors are going to be willing to pay more for those shares than they would some of these other stocks. Okay. But if we're looking at just a purely valuation basis, okay, obviously Stellantis doing very much cheaper on a price to earnings basis, as well as price to sales. Within that, I would say maybe Ford as well, doing very well on price to sales, very, very much cheaper. So if you look through here, you kind of look through, okay, which stocks are cheaper? Which stocks do I want to focus on? If you're looking at valuations, I think Stellantis actually has a very good valuation here. I would want to double check, see why earnings have dropped so much this year, and how long do I think it's going to take them to get back up to $5 or $6 per share earnings. If that payout ratio is durable, if that earnings, that dividend is durable, I want to look at the 3-year compound annual growth rate. This year and next year, why did sales drop 10% this year? Why are they going to rebound next year? And what's the longer term trend for that stock? But, taking just these basic fundamentals here, before I do my other research and investigation into these stocks, I would say Stellantis is a good deal here after that huge drop in the shares over the last 6 months. I'd also be looking at Toyota. And that's something that we're going to look at in our 5-minute walkthrough, our 5-minute quick analysis, why I would select Toyota over some of these others. Nation, I know this is a hell of a lot more work than just dropping a few stock picks in your lap and saying, hey, go buy these, but this is the kind of research that goes into real investing. I dig into all the stocks I talk about here on the channel, but you can't say that for a lot of the channels here on YouTube, TikTok, or across social media. You cannot depend solely on some influencer to feed you stock picks. So please learn how to do this basic stock analysis yourself, and let me know in the comments, what other resources do you want to see me do walkthroughs on, or other stock ideas you want me to cover? Now, folks, through the video, we have focused on just those basic fundamentals, the fundamental analysis of these companies. From here, you also want to, again, dig into this research, the news on these companies. Why are those fundamentals coming out as they are? We can see that just over the last couple of days, the Stellantis had its stock at its worst day since 2020, and probably worst day in most of the company's history. We want to dig into that report, why that stock has underperformed a lot of these others. We want to read other news in these other companies. What are they doing? We know that GM has pulled out of its EV ambitions much faster than some of the other companies. So maybe that's why their profitability is a little bit higher, why their earnings are improving over the next year, whereas some of these other companies are still investing or spending heavily on their EV ambitions, on their EV manufacturing, which is obviously quite a bit more expensive than others. Another great resource here, you can go to Google and you can type in any company name. So we'll do Ford here and then investor relations. You can see it pops up there, Ford Investor Relations. Now, the investor relations page of any company, they have to have an investor relations page or an IR page if they have publicly traded stock. So you're going to go here, and this is going to give you a lot of information to help you in your research. You're going to find all their financial statements, their reports, their filings, any events, so earnings reports, things like that. But what I like to look for is any presentations. A lot of times it's going to be in events. You can look here. This is the discuss commercial business. A lot of times you can describe, here's a presentation. So here's the second quarter earnings presentation. You can go in here. And what you're going to want to do, and you want to do this for each company that you're researching and kind of get a feel for what the company is talking about, where it thinks its addressable market is, where it thinks its competitive advantages are, as well as its maybe disadvantages. A lot of times what you can find here in these folks is you'll see most of the companies in the industry talking about a certain metric. Okay, so maybe free cash flow to price to free cash flow for valuation, maybe return on equity, anything that a lot of companies are talking about, but then one company just avoids it altogether. Okay, and then that could be a problem for that company. Okay, if everyone is using this metric or a certain valuation or a certain tool to really promote or present its company's financials, and then one company is avoiding that, that is your best hint at a problem for that company and something that you want to research. Okay, is it a durable problem? Is it a massive problem that really speaks to a competitive disadvantage for the company? So a lot of this, folks, this is a lot more work, I know, than just taking that fundamental analysis, those fundamental numbers, and then going through and then picking a stock. But this is the deep research that you need to do to really understand an industry and understand the stocks within it. Okay, this is why most analysts on Wall Street only cover maybe one or two industries, a few industries, or maybe one sector. Okay, just the stocks in that specific sector, because there is a lot of work in keeping up with the industry news, keeping up with different resources, websites, keeping up with demand as well as inventory and the general direction of each industry and the stocks within it. So again, that's why you see a lot of analysts will be a tech analyst. So they'll only cover that, or maybe even just a hardware tech analyst or software analyst, something like that. They will only focus on that one specific industry. They'll get really good at knowing where that industry is and which are the best stocks in that. And that's how they make their recommendations. It's very rare to see a generalist or somebody on Wall Street that is covering, all stocks. Okay. If they are, it's because they've got these other analysts below them focusing on each specific industry. Okay, so this is really the research that you need to back up those fundamentals with, is the company research, industry trends, and why they're affecting these companies differently. Why we see, different why we see different valuations. Why are investors paying so much more per share earnings for Toyota and and some of these others than they are for Stellantis? Okay. It's because of the operating margin, because these other competitive advantages we see in the stock. Now, I know that's a lot of work, and I know sometimes you just don't have time go through all that stuff. I do think you need to set up a chart here for stocks you invest in, each industry you invest in, and be able to compare these, be able to update some of these numbers when you go back to see, okay, is the stock I own really the best in its industry? Which are the trends that are really coming out in that industry? But sometimes you just don't have time to do a lot of this. So I wanted to give you that 5-minute idea of, really what you can do quickly to find the best stocks in the industry. And for this, I generally defer to growth and operating margin. Okay, again, we talked about that revenue growth. We talked about how that can be a real indicator of the company's competitive advantage, its advantage over its other peers in that industry. Why is Toyota growing at a long-term trend, not just this year, not just next year, that kind of thing, but a longer-term trend of 18% sales growth each year when these other, all the other stocks or all the other companies in the industry are only growing at maybe 11 or 12%. Okay, why is it able to do that so much faster? Okay, that is a real speaks to a competitive advantage. Okay, is it in the drivability in the cars? Is it in customer loyalty to the cars? Is it in the company's marketing or something? Why is it able to grow that much faster? Okay, and then the operating margin. I want to see the companies not only growing their revenue by these double-digit amounts, but that are also turning more revenue into income. And obviously, eventually they're going to be turning more of that revenue into earnings and earnings per share as well. But really that core operating profitability metric, that operating margin, that's what I'm looking at here as well. And I want companies that are really more efficient. And why are they more efficient? Okay, again, I think the Stellantis and Toyota, so much more efficient, so much higher operating margin than those domestic car makers. I think a lot of that, unfortunately, is the difference in unionization and non-union in their manufacturing. Again, if you're a union car worker, great. You're making a hell of a lot more money and a lot better benefits than if you were working for some of these other car makers. As an investor, I got to be a cold-hearted bastard, okay? I got to be a son of a bitch and just invest in the stocks and the companies that I think are going to make more money, maybe because they're paying people less, okay? That's just the difference you have to make between being, working at a job or being an investor, okay? The best stocks to buy aren't necessarily always the best companies to work for. Okay, I can tell you, Stellantis and Toyota still pay their workers going rates. They still pay good rates, especially here in the South where they have most of their manufacturing. But it is going to be less in pay and benefits than Ford or GM, where most of their manufacturing is more in the North and in that Michigan and Pennsylvania area around there, Ohio. So I'm looking at if Stellantis and Toyota can turn 12% or 11% of every dollar in revenue into operating income, and Ford and GM are only doing it at 4 or 8%. Obviously, I think that makes these much better stocks. Okay, so in that 5-minute analysis, you're going through here, you're looking at revenue growth, you're looking at operating margin. I think myself personally, I can ignore a little bit this PE and the price to sales, the valuation. I can pay a little bit. I can pay more for a stock if I'm getting so much better revenue growth and so much better operating margin profitability. Okay, because I know over time that stock that is growing 18% sales a year is going to grow into that valuation. Okay, if Toyota can continue to grow, 18% or just higher, just 3.5% versus 0.4% for Ford or negative 0.2% for GM, if it can continue to outperform on that sales growth, it's going to be taking market share, and that stock is going to grow a lot faster than these others. So I'm not quite as concerned about valuation if I have to make a quick decision. Okay, obviously, if I want to give it a little bit more time, I really want to look in here, and make the comparisons here on valuation, price to earnings, price to sales for these stocks. Then I want to consider that as well. Why Toyota is so much more expensive, and is it worth it to maybe invest in Stellantis instead, or even maybe General Motors, which is quite a bit cheaper than Toyota? Is the difference there enough to make me invest in General Motors, even though it is slower growth, even though it is slower operating margin, but it is just so much cheaper? That's what I want to do if I have longer to do that research, longer to do the analysis and things like that. If I don't have that time, if I want to do it quick in 5 minutes, then I'm just looking here at this growth, I'm looking here at the operating margin, and that's how I'm making the decision. Stay ahead of the news with the weekly bow tie and get all the stock market strategies, trends, and news you need to see, all free with the invite link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.